So while we're talking about random variables, there's a key concept, a key intuition that I want us to be able to take away from this class. So we're not getting into specifics of how the insurance industry works. If you're interested in actuarial studies, there are great classes that can get you prepared for taking exams to get into that line of work. This class is one of the first steps along that path, perhaps, but most of you are not going down that path, and that is fine. But I want all of you to have some basic intuition for how the insurance industry works. And we can do that now that we're talking about random variables. So an insurance company doesn't know what's going to happen. It doesn't know if a particular individual is going to lose their house because of a fire, if we're talking about homeowners insurance. Or if we're talking about auto insurance, they don't know who's going to be getting into a car accident, whether the car will be totaled, whether people will be injured in that accident. Those are all unknowns, right? But the key to the insurance industry, well, they can assign probabilities. They have a lot of data, right? So they know how likely it is for people like you to have certain health conditions in the next year. They know how likely it is for a house like yours to burn down in the next year, or a person like you driving a car like you have to get into an accident in the next year. So they can use the data they have to come up with probabilities for how likely it is to have certain outcomes happen where they will have to make payouts on the insurance policy. So most of the time, insurance companies don't have to pay out to most people, right? So that's how most insurance works. We'll think about liability insurance is certainly that way. Something like health insurance is a little bit different. The same basic ideas apply. But what we're thinking about here is most of the time you don't need insurance. You have it for those kind of rare events when something big happens. And so that's why you have homeowners insurance in case that fire does burn down your house. You're not stuck with nowhere to live and still sitting on a mortgage, right? Instead, you have insurance that pays out, maybe pays off your mortgage. You have some money to start rebuilding the house or what have you. So insurance companies think about this as a random variable. They can assign a probability to how likely it is that your house will burn down in the next year. There's going to be a big probability that they won't have to make that kind of payment. So there's an expected value to their payout for each policy. So maybe for me, the expected payout that an insurance company will have to have for a homeowner's insurance policy for fire protection is $100 for the year. Now, are they ever going to pay me $100? No. They're usually going to pay me $0. Hopefully they always pay me $0 because hopefully my house never burns down, right? But in the event my house does burn down, they'll pay me a lot more than $100, a low probability event with a big value attached to it. When we calculate an expected value, gives us some expected payout. Let's say it's $100. Now, what is the insurance company going to do? Well, they have to charge at least $100, right? We call it an actuarially fair premium when they charge the amount they expect to have to pay out on that sort of policy. They, in reality, have to charge more than that because they have overhead. They have to pay people to calculate these probabilities. They have to pay people to come and assess claims and adjust things. So in order to make their business actually work and to have some amount of cushion for when correlated events happen, they need to charge more than the expected value of the payout. Maybe they charge me $120 in premiums for this policy with an expected payout of $100 a year. Now again, I'm normally not seeing any money coming back from the insurance company, but in the rare event that my house burns down, I would get a big chunk of money from them to help me rebuild the house, right? So that's how insurance, generally speaking, works. They have a random variable, they calculate an expected value. We call that the actuarially fair premium, and they charge a premium that's at least a little bit higher than that, depending on how competitive the market is, etc. But they have to charge at least the expected value of the payout. Now, the key to understanding the insurance industry is to think about not just the expected value, that's really important. They also have to think a lot about the variance. So a random variable has a measure of central tendency, that's the expected value. You can think of that as being very similar to the average, the mean. There's also a variance to an expected variable. How much do we expect things to go up and down around that central tendency? When we talked about how spread out is a distribution, when we talked about quantitative variables, we use standard deviation or interquartile range as measures of how spread out can this variable be. So that is the same sort of idea for the variance standard deviation of a random variable. And so for an insurance company, what they want to do is have as small a variance as possible, in the sense that, well, they want to know, they want to be able to calculate how much they're going to have to pay out. And they have an expected value. They've assigned probabilities to how likely things are, right? But if there's a really high standard deviation for the payouts on a random variable for an insurance company, that means there's going to be really good years and really bad years for them, which is a lot harder to plan for. It means they have to have much more of a financial cushion to make sure they can get through those really bad years. So for insurance companies, they're always trying to think about how to get the variance or the standard deviation of their payouts to be smaller. And the way they do that is by having a lot of people in their pool. If you insure one person, then you're either paying out 0 or you're paying 100 grand to rebuild the house, right? Huge variance, either 0 or 100 grand. Now, if we have 2 people, now you've got more potential outcomes. You have 0 and 0, they both get 0, they both get payouts, one of them gets a payoff and the other doesn't. When you have, say, 1,000 people that are insured, well, now the numbers really start working more in your favor. Those probabilities, not only are you better at calculating what they actually are, you can actually use them to your advantage. And one way that works is the more people in your pool, when they're independent observations of each other, the more people in your pool, the smaller your variance of the payout is going to be. So your expected payout, the expected value may stay the same by adding another person to the pool that you're insuring, but the variance of the payoff is going to get smaller. So that's why insurance companies, it's really important for them to have a big enough group of people in there to be able to spread that risk over a large population, which means their variance of the payoff is much lower, which means their business is much more predictable. And that means that they can actually run on tighter margins. They can be more competitive. They don't need to be stockpiling a bunch of money for a really bad year. They don't have that big of swings between good years and bad years. The variance is really low. They've got a lot of people spreading out the risk. Now, insurance runs into trouble. Not all payoffs are actually independent of each other. So we talked about that with probabilities. When are things independent? When the outcome of one has no effect on another. So if we're insuring houses for fire, then generally speaking, they're going to be independent of each other. If we're talking about fires caused by careless smoking, by bad wiring in the house, by things like that that have no real relationship between the different houses. If there's a really bad lightning storm that comes through and that same storm sets off a bunch of fires, Well, there's actually a connection, right? The likelihood of my house catching fire is actually related to the likelihood of other houses catching fire if they're catching fire within the same lightning storm, or if there's a big wildfire. You see these a lot out west in California and places. There's been a drought, there's a big wildfire. Not one house burns down, but maybe 1,000 houses burn down, right? Those are not independent of each other. It's not like someone was careless while they were smoking. It's one wildfire that took out hundreds or even thousands of houses. That's when insurance companies have trouble. That's when their variance is big, and that's hard to predict because the models that assume independent outcomes aren't holding. So that's a little primer on insurance, how we can use random variables to think about it, the importance of not only understanding expected value, but also thinking about the variance of a random variable, and how if you're an insurance company looking at payoffs, you want that variance to be as low as possible, which you get by having a lot of people insured. Thanks.